Hi friends, I am Pradeep Kulkarni, welcoming you back YouTube channel P2G. In this channel, we deal video lectures, knowledge dissemination on banking. And in the process, in the second season, we had already offered so many videos covering the basics of banking, and now let's start looking into some typical terms or typical type of services such as factoring and forfeiting in this video. So let's discuss about the factoring. Factoring is a service offered. Factoring is a service. It is offered and that is concerned with financing and collection of accounts receivables. Means factoring is a service. In what connection with it? It is in connection with either financing or collecting the account receivables in a domestic trade or international trade. Means simple activity of managing accounts receivables, either giving money against that or otherwise even managing collections. That kind of activity is known as, that person who does it is known as a factor, and this activity is known as factoring. Reserve Bank of India, via their guideline 2015-16, circular number as it appears here, you can see the guidelines have been issued, and banks, as per that, banks may undertake the factoring activities departmentally. And which type of factoring they can do? Number one, recourse factoring. Number two, non-recourse factoring. Number three, limited recourse factoring. Now, these are the types of factoring. First, we need to understand what is meant by recourse factoring. Recourse factoring means, for example, A is a person who has sold the goods, and when he sells the goods, there is an invoice, and against that invoice, when bank is making payment to the seller, at a later stage, in case there is a default by his buyer, so where is the recourse available to the bank? Bank, if it is possible to take a recourse against the seller, then such a factoring is known as recourse factoring. And as per the terms agreed between a factor and the customer, there is a no recourse, then it is a no recourse factoring. Sometimes there may be possibility of a limited recourse factoring. And domestic factoring and the international factoring is when either of the party is there abroad, then it is a international factoring, whereas both the parties are domestically residing and buyer and seller are Indians, then it is a domestic factoring. Now let us understand how factoring works. At the very first stage, a person, manufacturer or the seller, he sells the goods, or a service provider, he provides the services, and after that he raises the invoice. Now once the invoice is raised, see that there is a possibility that payment may be coming immediately. Sometimes payment may have the, as per their agreed terms, 1 month, 2 month, 3 month, 4 month, like that period may be there. In case there is a payment lag, then naturally the person who has sold the goods, for the purpose of managing his liquidity, he may wanted to have money against that receivable, or he may be wanting this service to be done by somebody else on behalf of him. So therefore, according to that, he sets up a factoring account, and thereafter he assigns these receivables to the factor, and then the factoring company pays a part of it or discounts it, may pay a part of it, may pay advance money, may pay the discounted value of that particular bill, and thereafter the debtor, the on due date, when the invoices are presented, that is a bill of exchange is presented, then that bill of exchange is being honored by the debtor and he pays money to the factor. Then when payments are received, deposited there with the factor, then that is kept under the reserve, and out of that, the whatever his charges or the factor's charges or factoring discount is collected, as well as the advance, if it is paid, that also collected, and remaining money is passed on to the seller. That's how this cycle it works, and I'm sure with the help of this diagram you can easily come to know how the entire activity works. So in this process, bank acts as a factor and the customer, and in this process normally the invoices along with the bill of exchange accepted by the debtor is handed over, so that through that bill of exchange there is a possibility of taking recourse by even the endorsee, and endorsee happens to be the bank or the factor. Then in the same manner there is another kind of service called as a forfeiting, and mostly forfeiting is used in international trade transactions, whereas as I told you, factoring can be international, factoring can be domestic also, but forfeiting majority of the cases it is used in only the international trade transactions, and credit to exporters by intermediary, that is money given to the exporter by the intermediary, and that intermediary is known as forfeiter against the export receivable. In same manner, factoring, how the factoring, the bills and the bill of exchange and the invoice were handed over, same way here also handed over, but the difference is it is majority of the cases no recourse basis. Means once the bill of exchange and invoice is handed over to forfeiter, then the forfeiting agency or forfeiter will not have a recourse against the exporter. Whatever he has to do only against the debtor. Okay, mostly it is on non-recourse basis, and that too there is a reason behind, because a bill of exchange or that promissory note, whatever is there, that is avalized by the importer's bank. What is meant by avalization? Avalization means with regard to that particular bill of exchange or the promissory note, it is duly co-accepted by the importer's bank, and that confidence the exporter's bank is having, and based on that the money is parted to the exporter. Okay, now let us understand the difference between these two. So number one, factoring is a financial arrangement wherein supplier of the goods sells and its trade receivables to the factor at a discounted value for immediate cash payment, whereas forfeiter relinquishes the right, whereas in case of factoring the right of the customer is still intact, whereas in the forfeiting the right is relinquished, and trade receivables by the exporter to a forfeiter, and again here also at a discounted value money is received. Factoring can be with or without recourse. Forfeiting mostly it is without recourse. Factoring refers to discounting of trade receivables of the short-term maturities, whereas forfeiting mostly of the long-term maturities. Normally maturities are falling between 1 to 3 years, okay, or even they have maybe short as 1 month, okay, but normally 10 years, 3 years, 4 years, more the period people prefer to go for a forfeiting. The factoring involves trade receivables on ordinary goods, whereas forfeiting normally trade receivables on capital goods. For factoring, transactions does not set up a negotiable instrument, may or may not be, but in forfeiting compulsorily there is a negotiable instrument, and that too, that instrument need to be avalized by, means co-accepted by, admitted by the importer's bank. Okay, factoring does not deal in secondary market, and there is a possibility forfeiting may involve dealing in secondary market. Okay, factoring disburses the payment of the invoice immediately to the customer, which will be usually up to 80% of the value, whereas exporter in case of forfeiting gets 100% financing and free from risk involved export business. So interest rate risk, currency risk, credit risk, political risk, all those risks he is devoid of, and that's what is the overall scenario of factoring and forfeiting. Thank you so much for being with me. In next video we'll meet with some more advanced concepts, and that's all about the bank guarantees. Let's interact on that. Thank you so much once again. Bye.